Instructor continues the lesson. All right, let's move on to the next topic, authorized versus unauthorized insurers. When an insurance company wants to operate within a state, they must jump through certain regulatory hoops. Insurance regulators won't allow just anyone to set up an insurance company because insurers need to have sufficient funds to pay claims. You can't start an insurance company with just $5 or $10 in the bank. In fact, you'll likely need several $1 million to get started. Instructor explains the role of the Department of Insurance. The Department of Insurance is responsible for verifying that insurers are financially stable and able to pay claims. That's why they require insurers to meet specific requirements before allowing them to operate in the state. Once an insurer has demonstrated their willingness to abide by the rules, they are considered admitted and authorized to sell insurance. Instructor warns about unauthorized insurers. However, if an insurer doesn't want to follow the rules or hasn't received permission from the regulators, they are considered unauthorized. As agents, it's crucial that you do your due diligence and ensure the companies you represent are authorized and admitted in your state. If you start selling for fly-by-night insurance company without checking their status, you could be putting yourself at risk. Instructor provides an example. Let's say you contact the Department of Insurance and find out that fly-by-night insurance company is not authorized to transact business in the state. If you decide to sell for them anyway and they can't pay claims, you could be held personally liable. Your clients could come after your personal assets to recover their losses because you represented an unauthorized insurer. Pearl raises her hand.
What if we didn't know the insurer was unauthorized? Would we still be liable?
Unfortunately, Pearl, ignorance is no excuse in this situation. As an agent, you're expected to know better. It may seem unfair, but it's your responsibility to protect your clients by ensuring you only represent admitted insurers. Let's take a break, and then we'll resume with the next section on types of insurers. The class returns from the break. Welcome back. Let's discuss the different types of insurers in the marketplace. The first category is commercial insurers, which typically includes stock companies and mutual companies. Stock companies are owned by stockholders, while mutual companies are owned by their policyholders. Both are run by a board of directors. Instructor provides examples. If you own a policy with a mutual life insurance company, like Mutual of Omaha or State Farm, you are a part owner of that company. When a mutual company has a profitable year, they may pay out a portion of the profits to policy owners in the form of dividends. Similarly, stock companies may pay dividends to their stockholders when they have a profitable year. Don raises his hand.
Are dividends taxable?
Great question, Don. Dividends to policy owners of a mutual are not taxable. Dividends to stockholders of a stock company are taxable. Instructor moves on to fraternal insurers. Next, we have fraternal insurers. These are typically established by fraternal orders, such as the Lutheran Brotherhood or Woodman Life. Fraternal insurers are only allowed to sell to members and must operate on a not-for-profit basis. Some fraternals will automatically make you a member when you purchase a policy from them. Agents who sell for fraternal insurers must still be licensed by the state, just like agents who represent other types of insurers. Instructor discusses government insurance. The government is also an insurer. Think about the premiums you pay for Social Security and Medicare Part A. These are essentially insurance programs run by the government to provide benefits in retirement and for healthcare. Instructor explains reinsurance. Reinsurance is insurance for insurance companies. It allows insurers to spread their risk among multiple companies. For example, if a billionaire applied for a $600 million life insurance policy, a single insurer might have difficulty taking on that much risk. Instead, they might retain the first $50 million and then cede the remaining $550 million to reinsurers. This way, the risk is spread among several companies, protecting the financial stability of the original insurer. Instructor introduces Lloyd's of London. Lloyd's of London is an organization based in England that specializes in insuring unusual risks. For instance, a hand model might insure their hands with Lloyd's to protect their livelihood in case of injury. These types of specialized risks are not typically insured by local agents or standard insurers. Instructor moves on to types of producers. As agents, you are considered producers because you produce business for the insurance company. Life insurance agents typically don't have binding authority, which means you can't guarantee coverage as soon as the application is completed and premium is paid. Instead, the client must go through the underwriting process, and the insurer reserves the right to assess insurability and bind coverage. Pearl raises her hand.
Is that different for property and casualty insurance agents?
Yes, Pearl, it is. Property and casualty agents often have binding authority. Once they collect the underwriting information and premium, they can tell the client they're insured. If the client gets into an accident after leaving the agent's office, the insurer will cover the damage, assuming the appropriate coverage was purchased. Instructor explains the role of brokers. Brokers are another type of producer. They typically are appointed with multiple insurers and act on behalf of the insured, not the insurance company. When a client asks a broker to find them the cheapest 30-year term policy, the broker shops around to find the best deal among the companies with which they are appointed. Brokers usually don't have binding authority. Instructor discusses the legal implications of agent versus broker errors. If a client wants to sue a broker for an error, it may be difficult to hold the insurer liable because the broker represents the client, not the company. The insurer could argue that the broker's mistake is not their responsibility. However, if a captive agent causes harm to a client, the insurer can be held liable due to the presumption of agency. The agent's actions are considered to be the actions of the principal, the insurer, because of the principal-agency relationship. Let's take a break and then we'll dive into the world of term insurance. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 13. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 13. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 13. Good luck and keep up the great work.